Hello, we're excited to show you our native speech capabilities. Hello friends, today we will talk about what is a mutual fund. How much only we can see on TV that mutual funds are correct. Still there is fear in my mind. What if I make a loss? Are they showing the truth in the ads? Many doubts are there. Why does this happen? Because many of us are not aware of mutual funds and how they work. The biggest fear people have is that if I make a loss in mutual funds, if I lose my money. And our films have made the stock market infamous. So here I tell you, there are probably 300, 400, 500 schemes in the market. If you pick the worst scheme, you got a very bad advisor and he told you the worst scheme, 99% chance that if you stay invested for more than 7-8 years, then your return will be more than FD. You'll get a 9%, 10% return even if you select the worst scheme in this market. That's why there is nothing to fear, and it's almost impossible that you will lose in the long run. But if you have selected a good scheme, then your returns can be as high as 20–23%. That means your average return can be between 10% worst case, 20–22% in best case, which is much better than gold, property, or any other asset class. That's why you cannot afford to avoid mutual funds because of this return potential. Investing in mutual funds is very important. You will get better returns. So now as your fear is gone, let's talk about what's the mutual fund concept, how it works, and with that how can you invest in funds. And as a bonus, in the end I will tell you about 2 such funds which I personally like very much. So I will tell you all this and much more in this video. Hello friends, let's start with phonology. Today's video is designed for beginners who want to know all the basic things about mutual funds. First, let's talk about what is a mutual fund. Many people think that mutual funds are the only way of investing in the share market. But with mutual funds, you can invest in gold. If you want, you can invest in real estate. You can invest in debt funds. Or as you know, you can invest in the share market or equity. You can invest in all 4 through mutual funds. But mostly when it comes to the risk and return of mutual funds, the risk is high, can be a little volatile, but returns are high. Maybe it can go a little up and down. All of this is in the context of equity. This means the money that mutual funds invest in the share market in that context. To understand mutual funds properly, the important thing is to know the share market. What are the basics of the share market? Before going further in this video, I would recommend you to watch this video in which I have told the basics of the share market so your share market concepts will be clear. Now there are 3 ways to invest in the share market. First, research yourself which shares are good and what are bad, and pick your shares for yourself. The advantage is that you are not dependent on anyone, you are not paying any fees to anyone. The disadvantage is that it is time consuming. It takes time to find good shares and undervalued shares. You may not have the knowledge to do that, and it takes time to gain that knowledge. The second way is that you take the help of a research analyst or an investment advisor. To take help from an expert. The advantage here is you don't have to give time, just depend on them. The disadvantage is you have to make regular transactions. An advisor can tell you buy this share, don't buy this. They will take their fees, but you have to do the buying and selling. The third way is mutual funds. Through mutual funds, you can also invest money in the share market where you don't have to track regularly. Fees are low, you don't need to have stock picking knowledge. You just have to select a good fund. Now you know the basic purpose of mutual fund. That purpose is, as for equity funds, to give you exposure to the share market and to invest in the share market. Now let's find out how it works. See, if you want to invest rupees 20,000 and you want to invest yourself or through an advisor, the advisor has told you you can invest in MRF, Page Industries or Eicher Motors. That one share is above 20,000 rupees and you only can spend rupees 20,000. So you can't buy it. And that's a big problem by going direct or through an advisor. But what a mutual fund does is take rupees 500 from you and rupees 500 from someone else. Like that, it will take rupees 500 from 100 other people. Now it has rupees 50,000 and buys 2 shares of Page Industries. So if you were alone and invested rupees 500, then you couldn't have bought Page Industries shares. Now as there are 100 of you, together you bought 2 shares of Page Industries. So now people are 100 but shares are 2, so how will they be divided? Instead, mutual funds buy 2 shares and give you mutual fund units. So think 2 shares were bought, rupees 25,000 each, so a total of rupees 50,000 is invested. 100 people have invested, so mutual fund will give you units accordingly. So all of you have collectively become holders of those 2 shares. Mutual funds allow you to invest in more companies with less money, which you cannot do by direct investing. Now, how does mutual fund do this? They build a fund management company called AMC. That company launches funds and asks people for money, like we have launched a multi-cap fund and will do all kinds of medium and small investing. We have this expert who will manage your money. This is their track record. We assure you that we will give you good returns, so come and give us your money. So people like you and me who are interested, some rupees 500, rupees 1000, rupees 10,000, rupees 20,000, rupees 50,000 will give that AMC asset management company for the fund. Like that, all the gathered money will be called AUM, which is asset under management, total money. Now that AMC will appoint a fund manager who is an expert in picking shares. He will make a strategy where to invest this money and will invest in the share market and will give you mutual fund scheme units which you can sell anytime. Money will be sent to your account in 2 days. So this is the basic concept of mutual fund. Mutual means shared, like shared rooms in hostels. A mutual fund is such a fund where everyone's money is shared and a pool is made, and they buy shares with that pool money. It's the simple concept of mutual funds. Now let's see the advantages and disadvantages. The first advantage is more diversification with little money. If you want to spend rupees 2,000 to 4,000, you cannot buy many shares. But in mutual funds where everyone's money is pooled and invested in many companies, your small amount can be diversified. Second, you get an expert managing your money. The cheap price charged is called expense ratio. If you invest rupees 100 in mutual funds, roughly 98-99 rupees is invested and rupees 1 to 2 is taken as expense ratio. The lower the expense ratio, the better. Third, once you invest money, mutual funds keep buying and selling shares. You don't need to track regularly. Fourth, you must have heard about SIP. Once you set a bank mandate, every month a fixed amount is invested automatically. You can stop, increase or decrease SIP anytime. Now let's talk about disadvantages. First is the greed of some mutual fund companies. They may focus more on marketing and gathering money because they earn 1 to 2% of total investments. Second, when markets crash and people panic, they redeem money. The fund manager is forced to sell shares even if he wants to hold or buy more at low prices. Third, performance depends on the fund manager and research team. Sometimes mandates restrict investments, sometimes fund managers avoid risk to protect their reputation. Now the biggest use of mutual funds is goal planning. If you want money for kids' education after 10 years, marriage after 15 years, retirement after 20 years, you can select funds accordingly. You can create separate funds for each goal. For luxury goals like vacations, you can take slightly higher risk. But for important goals like education and retirement, choose safer funds. Your planning depends on many factors: income, dependence, time horizon, and importance of the goal. As I said, 2 funds I personally like: Quantum Long-Term Fund and Parag Parikh Long-Term Equity Fund. Besides that, you can check updated fund suggestions separately. Hope you cleared your basics about mutual funds with this video. If yes, don't forget to like this video. And if you haven't subscribed to this channel, press the subscribe button and bell icon so you get informative videos on time. If you want short videos like these, follow on Instagram, Twitter and Facebook. I will be bringing more such videos.